Hello guys, welcome to the Santarelli Trading Exchange, Options Made Simple. This is Dave Santarelli, and in this video we are going to cover a common option strategy called straddles. I will go over what they are, how to use them, when to use them, and how they make us profits. So, what is a straddle option? Simply put, a straddle is an option strategy that involves buying a regular call and put option for the same strike and same expiration date. This strategy allows the investor to make money regardless of the direction it moves up or down from a somewhat larger move. Now remember, with straddles, volatility is our friend. It doesn't matter if the stock goes up or down, regardless of the direction, as long as the stock has a larger than normal move in either direction, a straddle can make us some hefty profits. So we want to use this strategy when there may be some type of news or event like earnings or a new product announcement or something that can cause the stock to have a larger than normal move in either direction. So let's take a look at how a straddle works and how we would make money using this strategy. Okay, so in this example, we're going to use Salesforce, ticker CRM. So Salesforce CRM has earnings on November 21st with an expected implied move of the week of November 24th of 5.76% up or down. Okay, and here you see this is a snapshot here of what Wall Street is expecting. As you see here, Salesforce CRM, next earnings date is November 21st, 2017. AC means after close. Earnings is in 2 days. And they're saying that CRM, what Wall Street's expecting, has an implied weekly move for November 24th of 5.76%. And down here it says it has an implied monthly move of 6.26 for December 15th Expo. Okay, so let's use the 108 strikes for this example. We would buy the 108 strike call and put for a midpoint of $5 for both the call and put. The 108 strike call would cost us about $2.35. Now we have to multiply that by 100 since there's 100 shares in a contract with options. So it's going to cost us $235 per contract for the calls. And then we're going to buy the 108 strike put, and that's going to cost us about $2.65, which again, multiply by 100, that's $265 per contract. So this is for a total of $500 for one contract each of the call and put for the November 24th expiration on CRM. And as you see here, here's a snapshot of the order entry. You see up top here symbol CRM. I clicked on the straddles strategy. The stock last traded at 107.75. So how a straddle works is we buy to open. In this example, we're just doing one contract of each. We buy to open one contract of the call for the November 24th Expo, strike of 108, and then we buy to open one contract of the put for the same Expo, the November 24th, same strike, 108, for a price type of a net debit, which means it's taken out of our account. If that was changed to net credit, that means premium would be put into our account. So since we're buying, it needs to be a price type of a net debit. And I put a limit price here of $5, good for the day. And so this is going to cost us $500 for one call of each, the call and put. And if we wanted to change this to two contracts, So we bought 2 contracts of the calls, 2 contracts of the puts. That would just cost us $1,000, and we would have 2 contracts of each. But in this example, we're just doing 1 contract of each. So now, how does this straddle strategy make us money? Okay, so since we paid $5 for the 108 strike call and put, we need the stock to move up or down at least $5 from the 108 strikes just to break even. Okay, so anything above 113 or below 103, we start to make a profit. So if Salesforce is above 113 a share, we make a profit with our calls, or if it's below 103 a share, we make money with our puts. Here is what Wall Street's expecting. I already went through this above here, but here it is again. So as you see, they're expecting the stock to have a move of 5.76% for the week, which with the stock currently at 107.75 a share right now, that would be a move of $6.21 up or down. So if the stock had a move up of $6.21, that would bring shares to $113.96 a share. And if the stock had a move of $6.21 lower, that would bring shares to $101.54. Also, in parentheses I have here, this is just a general implied move that the street is expecting. Sometimes the stock moves much more or less depending on the earning results, depending on new product announcement, or if the company has better or worse guidance for the next quarter or year. Okay. So going with just what the street is expecting, the implied move. If the stock went higher to 113.96, then our 108 strike calls would be worth $5.96. Since we paid $5 for both the call and put, we would be left with a net gain of 96 cents, which again multiplied by 100, that's a $96 profit per contract. That's a 19.20% return with the calls. Now, if the stock had the expected move but went lower, down to 101.54, then our 108 strike puts would be worth $6.46. Since we paid $5 for both the call and put, we would be left with a net gain of $1.46, $146 profit per contract. And that comes out to a 29.20% return. Now, let's say there was major news and the stock had a larger than expected move, or it had a better than expected earnings report, and it had a larger than expected move than what Wall Street was expecting. For example, like Amazon. Amazon only had Wall Street was expecting about a 4% move, and the stock moved over 16%. So you can't really base it on what Wall Street's expecting, because depending on what the company does, how they report, or what type of news they have coming out, it could have a much larger move or even a smaller move. So let's say in this example that Salesforce CRM has a move of 9%. Here is how the straddle would work. So if CRM had a 9% move higher, that would bring shares to 117.45. And our 108 strike calls would be worth $9.45. Since we paid $5 for both the call and put, we have a net profit of $4.45, which is $445 per contract. That's an 89% return. Okay, if CRM had a 9% move lower this time, shares would be at 98.05. And our 108 strike puts would be worth $9.95. Since we paid $5 again for both the call and put, we have a net profit of $4.95. Multiplied by 100 again, like we always have to. That's $495 profit per contract. That's a 99% return. And with a straddle kept until expiration, one of the strikes will have value and the other will be worthless. So here is the option chain for CRM for the November 24th Expo. And I want you to take a look at this and try doing it yourself now that we went over it with using the 107 strike calls and puts. We went over it using the 108 strike calls and puts for that straddle. I want you guys to pause this and go over it doing the same thing we just did for the 107 strike call and put straddle. So basically what I'd like you to do is, when I say pause, what I want you to do is calculate how much it's going to cost you for the 107 strike call and put straddle. And then I want you to calculate the same way. If it has a 5.76% move up or down, calculate if it had that move up, how much you're going to make, and if it had that move lower, how much you would make. Okay, and then also do the same thing, like a 9 or a 11% move higher or lower, and see what you get with that. And if you have any questions, you can ask me, and I'll go over it with you and see if you came out with the right answers there. So you could do that. You could pause it, go over that. And if you want me to go over it with you, I will. But so what it's going to cost you is, you can see here theoretically, the 107 strike call is going to cost you $2.77. And the puts for the 107 strike are going to cost you about $2.10. So you add those together, that's the straddle. You add those together, 277 and 210, that comes out to $4.87. And so it's going to cost you $487 for a single contract of the call and put for the 107 strike straddle. Okay, so now note here that if you have a straddle with a further out expiration, it is possible for you to make money on both the call and put. How, you ask? So let's go over this. So let's use the same example we just used above with the 108 strike straddle. But let's say we got the December monthly expiration instead of this week's November 24th Expo. Let's say the stock shot up 9% and we sold our calls for the $945 per contract they were worth. It would actually be worth much more than that, since now with the December monthly expos, we have more time for the stock to go even higher, so the extrinsic value is going to be higher as well. But let's just say, to keep it simple, we sold it for that price, locked in the gains on the calls, and we do not want to sell the puts because they wouldn't be worth much, and it's going to cost money to close it out. But most importantly, we don't want to close out those puts because anything can happen in the market. The next day, the market could have a correction. If the stock drops, we might start to see our puts start to make some money and some profits. So when you have a straddle with a further out expo, it's not a good idea to sell both the strikes. If the stock shot up 9%, I would sell the calls, unless you feel like the stock's going to continue to go higher. You might want to sell half of them and keep the other half open, and see where the stock goes there. And like over here, using my example, if you watched my video on YouTube for breakout charts or breakout stocks, you would know when the time is to sell those calls for the straddle. So once you got that sell signal then for the calls, then I would sell the calls and leave the puts open. Because like I said, anything could happen in the market. The next day we could have a correction and the puts could start to be worth some money. So if we have a longer term expiration date and the other strike isn't worth much, I always like to keep it open, as anything can happen from now until December. If the market drops, or even if there's negative news on the company, or or anything happens involving the company or the sector or the industry, the stock has a drop, then since we already locked in our gains on our calls, we have a chance at our puts also making us a profit. So generally speaking, I never close out the other leg or strike unless I have some value in it worth locking in. So there's no point in selling a strike that's worthless unless it has some value attached to it. Just like, like for example, if we have a spread, I do a lot of spread trading. I have people, like for example, let's say I have a call spread, the stock drops, I buy back the short leg, and I keep the long leg open. Some people close out the short leg if it's, not worth much, but, you buy back that short leg and then you're long that call. It doesn't cost you anything since it's basically worthless, and then it has a chance of going higher. But that's a different story. You could watch my call spread videos or debit spread videos that I have on YouTube and check those out. But for straddles here, once I lock in the gains on either the call or put, I always keep that other leg open. I don't close the whole straddle out. Okay, so back up here, we see the chart for CRM. And like I was talking about before, if you watch which I highly suggest if you haven't done so already, check out my video on YouTube called Breakout Stocks or Breakout Charts, and or How to Trade Breakout Stocks. You'll see here, for example, CRM here, this is a beast. I mean, this thing's still in breakout mode. If you watch my video, you know that how I trade breakouts is using the 3 SMAs, and the day it closes above both of those SMAs, that's my buy signal. So right here on October 20th, I got a buy signal at about $98 a share, and we don't get our sell signal until the stock crosses and closes below the 10-day SMA. So as you see here, we got our buy signal on October 20th for CRM, Salesforce, and it has not closed below that 10-day SMA yet. So it's still in breakout mode. You got that buy signal at about $98 a share. It's almost at $108 a share now and still climbing. So it has not given us a buy signal and is still considered in breakout mode. So like I said, Salesforce is coming out with earnings on November 21st after market close, has an implied move of 5.76%. I'm probably going to be doing a trade on this just because Salesforce is a growing company. Actually, I get a lot of magazines, and one of the magazines, I think I left it in my truck. I'm at my office now, but I think it's still in my truck. But there's a list of the top 50 companies that still have aggressive growth ahead of it for 2018. And Salesforce is number 4 on that list. So I think Salesforce is going to do well for this upcoming earnings report, and I'm probably going to be doing a trade on it. So if you haven't already signed up for the Santarelli Trading Exchange, we have a great group, a great team of nearly 600 members. If you want to sign up, you could use promo code YEARTRADER, all capital letters, and that'll be for $1,000 off the normal yearly subscription of $2,400. And the website is thesantarelliexchange.com. And one other quick thing before we close out this video, I'm trying to keep videos under 10-15 minutes here, but it never seems to happen. We're at 20 minutes now. But next, here's a little foreshadow into the next video. So this video was on straddles, and the next video I'm going to cover is going to be on strangles. And basically, what a strangle is, it's the same thing as a straddle, but instead of buying the call and put option for the same strike price, With a strangle, you're buying a call and put with different strike prices. So for example, you may buy the 109 strike call and you may buy the 106 strike put, and that would be considered a strangle. So we can do a video on that next. And if you guys have any questions, please comment below. If you have any tips or suggestions for future videos, please feel free to comment that below as well. And please subscribe to our channel. Hit the bell button so you get a notification of when we post a new video. I also do a lot of live classes, so if you subscribe and click that bell, you will get a notification of when we are live. And we have a lot of great content to come, and we're doing at least one video per week. I had a death in the family, so I was busy the past 2 weeks dealing with that. But more videos are set to come here, and I'm looking forward to a great trading week. I'm going to be doing another video on this upcoming week here with the holiday trend coming up. I have some great trade setups I'd like to share with you guys. And trades I'm going to be sharing with TSC members. So again, if you haven't signed up, sign up. You could go to our business page and check out the reviews. We got a lot of great reviews. And if you have any questions, feel free to message me on Facebook. My Facebook group is Day Trading Stock and Options Room with, I think we have over 11,000 members in there now. And again, any questions, comment below. Any video topics you want me to go over or make videos on, comment that below. And again, subscribe to the channel and give us a like, a thumbs up. Thanks, guys. Take care. God bless, and happy trading.